Bloomberg Audio Studios. Podcasts, radio, news.
Hello, Merryn Talks Money listeners. Now, first, a quick reminder. We are recording an episode of Merryn Talks Money in front of an audience the morning after Rachel Reeves' UK budget. That'll be a depressing affair. Join us at Bloomberg's European headquarters in the heart of the City of London for croissants and smart analysis. I'll be joined by Helen Thomas of Blonde Money, Stephanie Flanders, Bloomberg's Head of Government and Economics, and, of course, John Stepek will be there. Find the registration link in the show notes. Space is limited, as ever, so do sign up soon. Onwards. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I am Merryn Somerset Webb. This week, Albert Edwards, global strategist at Société Générale, joins me in the London studio. The FT has called Albert a provocative and voluble strategist. Other people just call him famous investment guru. And my colleagues at Bloomberg like to call him a perma-bear. Sorry about that, Albert. Albert, welcome to Merryn Talks Money.
Hi there, and thanks for inviting me on. It's been a long while since I've been promising to come on. But here I am.
You have been promising to come on, I would say, for many, many years. But here you are. This is exciting. And I'm going to get as much out of you as I possibly can because I suspect you won't agree to come on again for another decade. So we're going to have to cover pretty much everything. So why don't we start with equity markets? Bubble or no bubble in the US, that is.
I think there's a bubble, but there again, I always think there's a bubble. But I think looking back, I've been in the markets now since 1982. I've been working, and these things come around from time to time. And during each bubble, there's always a very plausible narrative, very compelling. And hey, I know in previous bubbles like 2007 and even the Nasdaq bubble in late 1990s, even I start to doubt myself. And this is one of these times. Very compelling narrative, strong earnings, and but it will end in tears. That much I'm sure of.
We were both working back in the dot-com bubble days, and so we remember the run-up, right? Those days when we were told that the old valuation method didn't count anymore and that we should realign ourselves with the new plateau of the market, etc. And that because the new technology was going to change the world so enormously, valuations didn't matter, current earnings didn't matter. It was all about the future. So we remember all those things. And then, of course, it all went horribly wrong. Do you feel any of those things now?
I do, and the narrative is in some ways very similar, particularly when you see these extremely rich valuations in tech, over 30 times forward earnings in the US, being justified because of decent earnings growth. But one of the key comparisons, I think, is there. When you think back to the late 90s, the telecom sector, which we're getting, because it wasn't just technology, it was technology, media, and telecom.
Well, we used to call it the TMT bubble, didn't we? Yeah.
And the telecom sector were getting free money. They were laying cables, the amount of capital investment which was taking place on the back of the free money, a lot of it quite useful, but a lot of it a replication, a lot of it not needed, wasted investment, and how it strangled the other parts of the economy as money was sucked towards this sector. So one of the key comparisons, you had a bubble in earnings as well as a bubble in valuations, and then something always changes to pull the rug out from under it. Now, during the Nasdaq bubble, it was higher interest rates. The Fed was raising interest rates through the back end of 1999. But one key thing which people often forget is, despite these higher interest rates, as you moved right towards the end of 1999, people were so scared of the Y2K time bomb that we'd flip over to the 1st of January and all the computers would stop working.
So interesting. Younger listeners won't remember this, but no, we're talking about. There was this appalling fear that all of our technology, all of our computer systems would be unable to deal with this turn of the century and everything around us would collapse.
Absolutely. And it was prudent to buy lots of tins of baked beans. If everything went down, then I personally quite like eating cold baked beans out of a can. But if it didn't go down, it was fine. You had your cash in the safe. You just put it. It was just preventative. But what you saw, and you can see it in the I was chatting about it with one of my colleagues last week, and I showed him a chart of USM naught rocketing up towards the end of 1999. And then collapsing. As you flipped over into the year 2000, everything didn't shut down. The Fed withdrew that liquidity. And that is when the NASDAQ started toppling over. Now, as far as I can see at the moment, those same conditions aren't there. The Fed is lowering interest rates rather than tightening interest rates, and they're just moving away from quantitative tightening to be neutral. I think they'll go to quantitative easing quite soon. So normally when bubbles burst, it is usually the monetary authorities' tightening cycle, and that isn't there. And I feel a bit like towards 1999, I just got bored being bearish, basically rattling my chains, saying this is all a bubble, it's all going to collapse. And I find myself talking about something else a lot of the time. And that's the comparison which really worries me. I can feel that, this is going to go on for a lot longer. And actually, that's when something just comes out the woodwork and takes the legs from under the bubble.
Interesting. So, I mean, you are not the only person talking about a bubble. Neither am I. There's almost a bubble and people talking about bubbles, if you see what I mean. So it's not as though it's a contrarian thing to say anymore. It feels very obvious. But it also seems possible that there could be a melt-up from here.
Absolutely.
And people talk about melt-ups, and I'm like, kind of already had a melt-up. That looked like a melt-up, but maybe there's more melt-up to come.
As they sort of start to flip away from quantitative tightening to quantitative easing, and I think it will have to be, there's a lot of evidence that there's problems in the repo markets in the US and in the plumbing that the Fed uses, that they're going to be forced to shift to quantitative easing quite soon. And that, for example, could cause a further melt-up. And so when the bubble bursts, it will be even more damaging than it would be if you got it over with early.
And is this a bubble, do you think, that on bursting is similar in scale to the dot-com bubble, or is it worse in that to some extent the TMT bubble was sort of contained, and this seems to have a much deeper set of deeper tentacles throughout the US economy in particular?
I think what may make it worse this time around is that the New York Fed, for example, have shown that consumption growth has become more and more concentrated amongst higher earners, rich consumers, whose wealth has been inflated by the stock market doing so well. Consumption for the bottom 50% of income earners has actually been quite poor. So to the extent what has driven the economy forwards is AI investment, this sort of spaghetti of vendor, and that's another comparison, the spaghetti charts of vendor financing that we also saw in 1999. But what is slightly more concerning is I think the economy may be more reliant on the stock market going up. And if it goes down 30, 40%, 50%, and we've seen these before, a lot of people will be stunned that can even occur. But actually, consumption just gets hit very, very badly indeed. So it's not just an investment cycle, but a consumption cycle too.
Yeah, and that might be particularly bad given the huge retail participation in this bubble, particularly in the US, right? And I keep looking at the number of leveraged ETF launches.
Yeah.
Single stock leveraged ETFs.
And certainly after Liberation Day, when President Trump backed off his initial tariffs and the stock market started going batshit crazy from that point onwards. Yeah. That was retail which drove that. And the professional investors, we could see from the surveys, were very reluctant to participate. They were still quite bearish. They were expecting a recession. And they really dragged kicking and screaming into the market by retail. Yeah. Just buy the dips, always. Just buy, because the stock market never goes down might pop down 10%, 15%, but it doesn't go down 30, 40, 50% anymore.
Until it
Want
does.
to bet? Until it does.
Until it does. Exactly. Let's leave aside what might be a trigger for the end of the bubble or for preventing a melt-up. But a lot of this idea that it might go on, there might be a continuation in the bubble, is about inflation and interest rates, right? As you just said, so you're expecting the Fed to keep cutting rates. We're expecting rate cuts in the UK, etc. But you've also written about the deflationary environment in China.
I mean, if any other economy, G7, major G7 industrialist economy, had seen the level of economy-wide deflation that China is suffering. So China has seen 12 successive quarters, not months, quarters of year-on-year declines in its GDP deflator. That's economy-wide. So it's more than just the CPI or RPI. It's economy-wide, includes exports, includes investment goods, etc. If any other economy had seen that, they would be printing money like confetti and chucking it into the economy. China is in a real hole in terms of its deflation. And as we know, having followed Japan over many years, the worst situation to be in is when you're a highly indebted economy, as China is, and then to suffer deflation because it crushes you.
Well, it increases the real value of people's debt and makes it even harder to pay off. You want inflation if you're in debt, not deflation, right?
Absolutely. And Robin Brooks, who I follow, who's at the Brookings Institute, no relation to the name, but he pointed out that China's PPI on consumer durable goods is accelerating downwards. It's down 4% year on year, and it's getting worse. And this is part of their surplus capacity problem. They've got a lot of deflation to give the world, and they want to get rid of it. And the big surprise could be, where, especially in the US, where everyone is waiting for inflation to pick up because of the tariffs, is it just doesn't. That inflation, we had a downside surprise in the UK recently, albeit from quite high rates, downside surprise in Japan. US has broadly been surprising on the downside. Looking at their underlying driver for inflation, which is unit labour costs, is what I've been writing, is look, unit labour costs and unit costs are only running at 1% year on year. And that's not an erratic number, that's smooth. That's what most economists think drives inflation. And that's been coming down quite smartly, as has company inflation. The corporate price deflator has come down. And that's running quite a way below core CPI. And I think the big surprise may be not the economy suddenly drops into the recession in the next few months, but inflation really carries on undershooting. The bond rally really gets going, which will cheer Rachel Reeves up no end in the UK. And actually, that inflates the stock market bubble even more, perhaps.
But it's not ideal for deeply indebted Western economies. If one of the things that we talk about a lot on the podcast is how do you deal with this level of public debt? What on earth can you do about this? And the answer, of course, is a type of financial repression.
Yep.
Running interest rates slightly lower than inflation for a long time so that eventually your debt doesn't necessarily go away, but is massively reduced. So that in some ways, the last thing that an economy like ours wants right now is another wave of deflation out of China.
It's a get-out-of-jail-free card for the politicians. Cyclically, I could think we can get a downshift in inflation. On a secular or trend basis, I mean, I'd been known for many, many years for my Ice Age thesis, which I put together at the end of the 90s, the West following what happened in Japan, that inflation would come low and low and bond yields following that. After the pandemic, I have switched camp into a secular rise in inflation. I can remember personally 28% inflation in the UK, and actually in Japan also had 28% inflation. I think seeing the fiscal, on a secular basis, seeing the fiscal incontinence which is there and the fiscal dominance over monetary policy, I can see inflation trending back up to double digits. You might get some short-term relief, but actually politicians seem congenitally unable to get to deal with these fiscal deficits, which means the path of least resistance will ultimately be money printing.
So we might get some short, medium-term relief from the Chinese situation, but medium to longer term, we have to expect higher inflation because there is no other thing that can happen without politicians getting a grip, which they're quite clearly not going to.
And populism. Anyone in the UK who suggests, for example, we get rid of the triple lock on pensions will be voted out of office immediately. Perhaps best not to say it in the run-up to the election.
We're speaking on the day that Rachel Reeves has been out talking this morning about the budget, which is getting increasingly weird that you come out 3 weeks before a budget to tell everyone there's going to be bad news in the budget to make them feel really miserable in advance of the budget and make things even worse than they were already. But here we are. That's what she's done. And she's made it pretty clear that this isn't about spending cuts. It's not about getting grip on public spending. It is about taxing everybody more. It's no longer about broad shoulders. It's about kind of everybody's shoulders.
Yes, and getting a hold of the spending, particularly welfare spending and disability. And we saw even with I think global bond markets took a big lesson from this. The Labour Party, even with a 180-plus majority, couldn't get through the most minor of reforms in terms of disability spending, where alone in the world, particularly for under 30s, it has exploded upwards as people get signed off. And they're TikTokers to actually explain to you how to game the system to do this. Yeah. And they're just totally unable to get a grip on it. And it's, although the UK isn't the worst offender by any means, I think the US is worse, I think France is worse. Both those countries are more protected than the UK. France because it's wrapped up in the Eurozone wrapper, US because of the dollar and the exorbitant privilege of being able to borrow in the dollar. But the UK is far more vulnerable to a blow up. I mean, luckily we're in a period where bond yields are coming down. And this is what blew up Liz Truss. Her budget came at a time when bond yields were rising sharply globally. And it wasn't a good time to hit the markets with that sort of...
And also she hadn't put any effort into getting everyone else on side.
Exactly.
It came out of nowhere.
Exactly.
But so we have this massive public debt problem. And as you say, this sort of fiscal dominance in the UK and elsewhere.
Yeah.
Is it concern about that the gold price has been signalling?
I think it is. I think people are joining the dots. And I think the debasement trade, and it is because it's not just gold until the recent correction. It's had a very deep, well, it is enjoying a very deep, enjoying is not quite the right word if you're holding it. It's seeing a very deep correction at the moment. But it's not just gold, it's the entire precious metal complex, which ran up very, very sharply. Incidentally, from the date of August the 22nd, Jerome Powell, the Fed chair's Jackson Hole's speech, gold ran up 30%. But actually, the rest of the precious metal complex rose even more strongly. Now, you got to the stage where gold was so overbought. Technicians look at things called relative strength index, RSIs they're called, how far the price has moved from the moving average, essentially, had a monthly RSI of over 92, which was the highest in history for the gold market. So you're going to see a very deep correction. But I think this is the debasement trade. Why aren't bonds yields also rising at the same time sharply at that time? I think it's basically because, and people say, well, it's not a debasement trade because bond yields, if people expected very high inflation, bond yields would be rising.
The bond market would collapse and yields would be going to the sky.
And it's because people figure out, because of fiscal dominance, the central banks will be told to intervene to hold down bond yields at some point, whether it's 5%, whether it's 5.5% or 6%. At some point, the maths just do not add up anymore for fiscal sustainability. So there would have to be yield curve control, or as Japan had for many years, yield curve control or quantitative easing, which is effectively yield curve control. So yeah, the precious metals can rip raw upwards, but the bond yields don't in the same way. They start to stall out as they get to higher levels.
So you think gold will come back?
Absolutely.
We're just under 4,000 today as we speak. We're $3,967. But it seems likely to me and to John, who's on the podcast with me a lot, that gold will go back over 4,000, and it's still something that one should hold on to
silver,
under the
platinum,
circumstances.
Yep, gold, silver, platinum, palladium, all of them.
You're holding all of them.
Gold might be the laggard.
Gold miners?
Yeah, GDXJ. I don't personally recommend stocks. I wouldn't know. I'm a macro person. I wouldn't know a stock if it bit me. I just wave my arms around and talk about the macro backdrop. Yeah. And actually, there was quite my former colleague Dylan Grice, who you know very well.
I know Dylan well.
Used to do a lot of research about the what happened to Germany in the 1920s.
Yes.
And why Rudolf von Haverstein, who was the Riksbank governor, why he kept on printing money. And the conclusion was, and I think it was a quote in later life, was he basically kept on because he was scared of the economic and social consequences of stopping. And it's similar with the public sector deficits. The politicians are scared of the social consequences of stopping spending money and throwing money out as they are doing. And these huge spending plans they've got. And so the path of least resistance is money printing.
They can just keep it going for another few years, another few years. And if you like, kick the can down the road, figure it out later.
The COVID period, it didn't, if you like, spoil politicians into thinking they could spend like this. And eventually the markets come for them. They look around for the weakest candidate. That may well be the UK at some stage, even though other countries are worse. Yeah. They'll pick off the weakest candidate and basically bludgeon them and make an example of them. But that's which is why we're going to end up with quantitative, unlimited money printing to hold down. And if the central banks won't do it, I always like the Groucho Marx quote, "These are my principles. If you don't like them, I have others. These might be my central bankers today. If they don't do what I say, I'll find others to do it."
Yeah, so central bank independence as ever is something of a myth, isn't it?
It is absolutely
it's just not real. Yeah. Now, on the subject of central bankers, what part do you think that central bank buying of gold is playing in this? So we've seen, various central banks around the world, China in particular, constantly adding to their gold holdings.
I think this is a natural consequence from the pivot away from US assets, which was, people tell me, and I think it's a reasonable hypothesis, partly a consequence of the seizure of Russian assets after the invasion of Ukraine. I was reading a narrative of the cabinet meeting in the US where everyone was talking about seizing or freezing their assets. And Janet Yellen did demur about, shouldn't we think through the economic and financial consequences of this? But it certainly weakens, because which emerging market central bank, which might fall foul of the US at some stage, is going to buy US assets and deposit them in the US to be seized later on. And I think that's partly what is going on here. And you can see it from a lot of the hegemony of the dollar has been weakened somewhat. I don't think people who say that age of the dollar is over, I think are premature. But that, I think part of it is that is what is going on. And it's perfectly logical.
Does it make sense under those circumstances to also hold some cryptocurrencies, to hold Bitcoin in particular, do you think?
To the extent that crypto is a bet against central bank competence, which is what my former colleague Dylan Grice always used to tell me, is I would add it to a portfolio, but with a very skeptical and cynical view about it, that it could collapse at some stage. But what I've noticed more recently in the last few months, it does seem to be a bit of an inverse correlation to gold. So you're putting the two together, and it does tend to dampen down the volatility. So I think there certainly is a place for cryptocurrencies if central banks are going to do what I think they're going to do.
Yeah. But if that is the case, if we are looking forward to a period of very high inflation, surely there's also a case for holding equities. And we've talked on this podcast about the Gavkal's Turkish portfolio, where it's 50% equities, 50% gold as being the way to get through an unpleasant inflationary period.
I would agree with that because you're buying a real asset. And I think commodities also as part of that, another real asset. The earnings will rise in nominal terms probably in line with nominal GDP growth. But the key question is, and that offers the protection, the profits growth, is in highly inflationary times, what multiple should the market be on? So the US is on currently a forward P of 23 times, which is almost back to where it was during the NASDAQ bubble. In 1982, normally when there's high inflation, the P is extremely low. And what you saw from 1965, for example, from 1965 to 1982, as inflation rose and as bond yields rose, there's really good earnings growth. The Dow went nowhere for 17 years in nominal terms because the P, which started at around 20 times, if my memory serves me right, in 1965, deflated, I think, to 8 times earnings by the time inflation peaked out. So, yes, what I would say is in an environment of rising inflation and rising bond yields, what has worked for the last 20 years will stop working. So bond beneficiaries, stocks or sectors which benefit from lower bond yields, so they tend to be defensive, they tend to be utilities, they tend to be growth sectors like tech, which have done very well from decades of falling bond yields. And what hasn't done so well were cyclical stocks, value stocks. So what hasn't worked should start to work. When things have worked for 20 odd years, or so longer, hard. It's getting out of that mindset and saying we're in a different paradigm. So yes, I agree with you. Stocks are a hedge against inflation, but it's working out, well, if we go through a secular derating, actually that can wipe out all those gains.
Find stuff that's cheap already.
So it's ambiguous for stocks.
Yeah, now I see that. Now, listen, speaking of sectors that have benefited, or asset classes, should we say, that have benefited from very low interest rates. Private equity. We're going through a period when we are hearing constantly that it's time for retail investors, for ordinary private investors to get their hands on a whole load of private equity, and that will really pimp their returns going forward. I'm looking at you and I'm thinking you don't necessarily agree with that.
Well, I'm very cynical generally. Awful trait I picked up over the years working in finance.
And me having that as well, but I shouldn't really have had you on, actually. Terrible mistake.
As far as I can see, the big advantage of private equity as being carried interest is it's tax treatment, gives it an advantage, and it doesn't have to mark itself to market. So it isn't very volatile. People say, well, we haven't got the volatility in private equity. Yeah, but you don't know what it's really worth.
Well, you do have the volatility, or you would have the volatility if you tried to sell it every day. You'd know what the price was.
But, there are problems in the private equity space, as people call it at the moment. And you've had 2 high-profile bankruptcies in the US with First Brands and Tricolor. And I know nothing of what they do and understand, but I know that there have been problems there. And that has started to leak into the high yield bond market. Spreads have started to widen because people are worried. And Jamie Dimon of JP Morgan has come out and said, well, you never have just one cockroach. Well, you've got 2 there. And it's not just the IMF have been warning about private equity. Andrew Bailey at the Bank of England is very worried about it. And people don't really focus on this. And maybe this is the thing which in this cycle, every cycle is slightly different. Maybe this is the thing in this cycle which will lay us low. I don't know, but there's an awful lot of leverage. One of the elixirs for private equity is leverage. Huge amounts of leverage.
You're not really allowed to say that, Albert, because what private equity people would like you to believe is that it's got nothing to do with debt at all and everything to do with being better at managing.
Really, yes. I think I'm just too cynical. I'm sure they're wonderful, and I'm sure some of them are. I'm sure some of them.
But I suppose one of the problems with the performance record of private equity is that, when you talk to private equity people, they will say to you, well, look at the long-term performance record. It's really great. But if you go back to the very beginning, say you're looking at over a 15 or a 20-year period, if you go back to, 15 years ago, this market was tiny. Yeah. And you had a very small number of super intelligent and effective people working in a very small area. So that doesn't tell you anything about performance when it's huge, vast amounts of money in every single mathematics graduate wanting to work in it, etc. It's a totally different sector now to the sector that we look at the performance of 15 years ago. Is that fair?
Yeah, no, absolutely. And you can tell that's the bubble conditions because certainly they are sucking the engineers and sort of people who used to go into finance, investment banking, for example, they're all getting rich in private equity.
Outrageous.
One of the big problems for private equity, like so much else, is they benefited from years and years of falling bond yields. And the mood music has now changed. I know bond yields might be coming down just at the moment, but if we're in a secular zero, we're not in my view, we're not going back to where we were. We're in a secular bear market for bonds, and if you're highly leveraged, it's going to be a major problem. And what you seem to have is a very few number of companies at the moment related to AI, which are doing very, very well. But you scratch the surface, and my colleague Andrew Lapthorne does this for me. You remove the top, not even 10% of companies, quoted companies, the top 10 companies. And underneath that, things are pretty crappy. And as you drill down into smaller and smaller companies, things are really, really tough. And people talk about a K-shaped recovery within the consumer sector and within the corporate sector. It's very, very, there are very small amounts of winners which are out there. And so the mood music maybe for private equity, and certainly in the UK, where you've got private equity taking over the vets, taking over care home, nursing homes, and people just don't realise how their tentacles have spread so deeply into the real economy. And the UK is a really good example. If your vet isn't owned by private equity, you're doing pretty well. But it's to me, it's a real issue.
Yeah.
I wouldn't say problem.
Yeah.
Because that's a bit pejorative. Yeah. It's an issue. It's an issue we should be watching closely.
We should be aware of.
And as Jamie Dimon says, you never get, I don't want to compare private equity to cockroaches.
You do,
but
don't you?
But you never, as he said, you never just get one cockroach as these things start going bust.
So we're worried about private equity. We're worried about inflation. We're also worried about deflation. We're worried about equity valuations. We're worried about an
I'm amazed
AI
I haven't got more lines. You can see over there, I haven't got many lines here, but I'm amazed I'm not more wrinkled.
Yeah, and for those of you who can't see Albert, which actually is all of you, he's not remotely wrinkled, and he's wearing a great seasonal shirt. We might put a photo of Albert online. We'll promote it.
That'd be lovely. That'd be lovely. Do try and Photoshop me a bit.
No. So here's the question, Albert. What could go right?
Well, what could go right, I suppose, is the bubble just carries on for another year. The interest rates come down, bond yields come down on a cyclical basis. We go to 40 times forward earnings. Some of us have seen this all before. I'll stop talking about equity bubbles and start talking about gold or my personal life as I have done in the past instead.
But that's not going right, is it? That's just going on a bit longer.
Yes. I don't think there are any good options here. What's the least bad option? They've kicked the can down the road for so long.
What about this? AI does everything that it is promised to do. There's a massive productivity wave throughout the Western world, which brings down government spending massively, hugely reduces our deficits, gradually starts reducing the debt, makes every company more productive, such that valuations are perfectly fine. and everything's okay. Everything's okay.
Can I sell you a bridge? London Bridge is for sale.
Really? No chance?
Certainly, productivity growth in the US has been looking okay recently.
Mm-hmm.
What's interesting is no one has a recession on the horizon. The latest Atlanta Fed numbers for the next quarter, 4% GDP growth, driven a lot by AI investments. But when I look at, I was looking at the ADP in the absence of official payroll numbers. So the biggest driver for employment is not the mega caps or the AI companies. It's mum and pop. It's companies. It's unquoted companies. So I was looking at, and the ADP in the US divide it up into company size. And those companies with less than 50 employees comprise 45% of employment in the US. And employment is falling. In the latest numbers, year on year, it's very unusual. Employment for smaller companies is falling year on year in the US. And it's not a rapid dump down. It has accelerated a bit, and maybe that's something to do with the immigration policies in the US. But actually, it's been slowing down quite rapidly for the last 2-3 years. So large cap employment still looks okay. That's slowing. But when you have the job generators in the US, small cap companies in recession, then you think, actually, so the stock market may be at all-time highs, but actually the rug is being pulled out from underneath. So all this AI investment is going on with this vendor finance scheme between all of them. But actually, could this be the rug that? But I tend to look on the dark side. So I'd recommend all your listeners should ignore me totally.
Okay, well, let me try.
And it's just background.
Yeah, let me try something else on the positive side. Okay, so in the UK and particularly, one of our big problems is very expensive energy, massive drag on the economy. If we accept, which we do, that all economic activity, in fact, all activity, one way or another, is energy transformed. If we were to find a way in the UK, and possibly elsewhere, to massively bring down the cost of energy, say, I don't know, beaming solar power from space to a massive mirror somewhere, something like that, which some of our guests have talked about, that could do things. Even in the UK, abandoning net zero, for example. That could be a massive positive. That could be transformative. And the solar to mirror could transform the US and the rest of the world. Imagine energy being practically free. I'm really working as hard as I can here, Albert.
I think that would be transformative if it happened. Certainly the UK is an outlier. The UK has some of the highest energy costs in industrialized countries, but that's because of the ludicrous pricing mechanism we have here, which I'm sure all your listeners will be aware of, where even if 99% of the energy being generated is from low-cost renewables, which is not, but assume it is, and the gas price goes up, the average, the pricing in the UK is off that marginal producer, which is usually an expensive gas generator.
Yeah.
And so everyone has to pay that marginal price. And it's a ludicrous system. So that's one of the reasons our energy costs are so high here. And you have to break that link, because what's happening is the renewable companies are getting a massive, massive subsidy from the consumers. But there doesn't seem to be any will to break that ludicrous link here in the UK. But the UK is totally almost deindustrialized now.
Yeah, it's kind of too late.
It's too late for the UK, to be honest.
Okay, that didn't get me anywhere either. Nothing left in terms of trying to encourage you to think of something positive.
Well, I think when you've been through many cycles like you and I have, you know the inevitability. And the business cycle, the one thing which cannot be abolished is the business cycle. And apart from 2 or 3 months during the pandemic, the US hasn't seen a proper cyclical downturn since 2008. Now, that is an extraordinarily long economic cycle. A recession will come along, and all these bubble elements will implode. It may well be the bubble implodes and then brings the economy down into recession.
Or it could go the other way.
And that's going to cause a lot of surprise. But we can inflate a lot further from here. We've been doing this long enough to know anything is possible.
Okay. So in the meantime, all we can do is hold precious metals and inexpensive equities to the best of our ability and wait.
And if you want to ride the equity bubble, yes, do so, but just be very cynical about it. Don't believe the story. Momentum investing is one of the most profitable methods of investing. My colleague Andrew Lapthorne has shown me that. Yeah. But just have clear technical signals to get you out, whether it's the S&P or cutting below the 200-day moving average or whatever it is. Don't buy into the rhetoric too much. Ride the bubble if you so wish, as George Soros says. When he said, whenever I see a bubble, I run towards it. But don't get consumed by the story. Be very cynical and just have a level to get yourself out so you're not bankrupted when the thing turns down. So as Chuck Prince said, you got to keep dancing while the music's playing, but just decide how near the fire exit you want to be gyrating around on the dance floor. And
don't be tempted to move back in front of the band.
Exactly. Put your earplugs in so you can't hear the music, right? But just keep moving around.
Keep jiggling. All right, let me ask you one last question then. What are you reading? Came here on the train. What were you reading?
I don't read very much, actually. What I normally would do is get my colleagues to read. They do the heavily lifting for me and read all the economics or finance books, and then they just tell me what's in it.
So what are you reading? A nice cozy crime novel?
No, I just
poetry.
No, I'm not. I generally read current events. I like reading a lot about current events. I have been reading Boris Johnson's biography. Just to balance that, I did read Gordon Brown's one before that. So I'm very eclectic in my taste. But I'm not. I'm very lazy. I generally, in the evenings, what I do is basically just watch telly. I watch rubbish on telly and unwind. I'm so caught up with the tension of financial markets during the day.
You must be so excited. Are you so excited about the Bake Off final?
I've never watched Bake Off.
What kind of are you watching on the telly then?
Even than Bake Off. Even than Bake Off.
People.
No, I've been watching Ted Lasso.
I mean, all the tension in my life has been about the way those sugar dome things all broke last week.
I'm not a big cook. There's someone laughing in the background here at me. It's outrageous.
Right. Albert, thank you. Thank you.
It's been a pleasure. And we must do this again. We mustn't wait another 10 years.
No. Can we do it once a year?
Maybe.
Once every 2 years. I want to hear on-air commitment.
On-air commitment. Every couple of years, definitely. Yeah.
Couple. I'm interpreting that as 2. So I've got a better idea. How about we do it again straight after the crash?
Absolutely.
Straight
Next week
the
then.
It's a deal. Could be in 10 days. Thank you for listening to this week's Merryn Talks Money. If you like our show, rate, review and subscribe wherever you listen to podcasts. Keep sending your questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW and John is John_Stepek. You are on Twitter, right, Albert?
Yep.
What is it?
Albert Edwards 99.
There are another 98?
No, I jumped over all the rest of them.
Okay. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi and Moses Andam. Sound designed by Blake Maples and Aaron Casper. And special thanks, of course, to Albert Edwards.